are you like the dumbest financial advisors ever? But what we're really focused on is how do we minimize taxes for our clients? Or how do you minimize taxes for yourself over the course of your whole lifetime?
Hi, Meg.
Good afternoon, Scott.
Welcome to another episode of Real Personal Finance. Today, I'm so excited. We get to talk about tax projections.
Didn't we talk about something equally, like I think we talked about employee benefits last time, and it was sort of
Yes,
equally falsely enthusiastic.
I
Like,
know.
this is crap you just have to deal with, so let's
Yeah,
talk about it.
yeah. If you don't do your taxes, you go to jail.
Yeah.
But if you pay attention to some things before December 31st, right? So ahead of time, and you project what you're going to owe, you can probably make some changes with your cash flow, your balance sheet, your portfolio, and your taxes, so you pay hopefully less in taxes.
Yeah. And I think both you and I have spent probably a lot of time over the years with clients
Yep.
sort of reshaping their conception of or their relationship with taxes, shall we say, away from this idea of, oh, I don't think about taxes until like February 15th, where I, desperately look around either for a tax preparer or I start getting 1099 tax forms from my investment account.
Yeah.
And I think that's probably still how the vast majority of people think about it. Tax time is February through April. And we are here to say that if you are still figuring things out at that point, you've lost.
Yeah, it's too late. So you're really like truly, to your point, if you're start doing things February through April or February through October, if you extend, you're really just looking in the rear view mirror of your car and just like reporting what happened in the past.
Right. At that point,
Right?
you're just trying to stay out of jail.
There's nothing you can do to change anything, really. There's little things you can do, maybe, but they're fringe. What we're talking about today is really looking through the front windshield of your car, driving on the road before you hit December 31st, so you can really make some changes and affect change in your life.
Yep. And that's why both you and I highly recommend to our clients to get tax projections in sort of the last 3, maybe 4 months of the year, because that's sort of the hit my microphone here. That's sort of the sweet spot of it's late enough in the year that you're pretty sure you know what your full year tax picture is going to be like. You can kind of project how much more income you're going to get, that sort of thing. So you've got enough information to be confident in your understanding of your income situation, but it's still early enough to make changes if the tax projection reveals to you opportunities.
Yeah, absolutely. So let's look at the 6 opportunities we think we commonly see.
We counted. Yeah.
Clients have. I just counted. I think
there was a pause.
I moved my lips while I was counting because it's a very high number.
Hire Scott, people. He can count to 6 silently.
but I have to move my lips.
But he has to move his lips.
Yes.
Yeah.
But no, the things that will, so not only do that with an accountant, but you can do it with the help of your advisor as well. So like we're commonly working with, as you just said, with accountants and with our the clients, and we're asking for clients. We're going to ask for things like your pay stub, right? We're going to make sure we have your vesting schedule for your RSUs for anything that's still to come this year. If you have ISOs and NSOs, we're going to want to see those to see what's available for you and what's been done through this year. And then we're going to want to see last year's tax return to have a base place to start. Now, if you already have an accountant, they're already going to have most of this stuff, which is really nice. Yeah. You're really just getting them the intra-year data, the data that happened this year versus the previous stuff, which is nice. But what are the common things that you see come up when we look at projections? What's the top one for you?
Ooh, I think probably top one is Roth conversions. The opportunity to convert usually your IRA money to a Roth IRA because you're in a particularly sort of anomalously low income and low tax rate year. We have a lot of clients who have taken sabbaticals, so they have intentionally
Mm-hmm.
not worked and not earned income.
Mm-hmm.
And then over the last year or two, we've had a couple clients who have been involuntarily not
Yeah.
working,
Yeah.
and that sucks, and we wish it were different. The silver lining is, hey, perfect opportunity to, at sort of low tax cost, move a bunch of money from this pre-tax account, where if it stayed, 20 years go by, now you're retired and you're taking the money out, you have to pay taxes on it then.
Mm-hmm.
Move it to a Roth now. You are voluntarily paying taxes on it now,
Yeah.
but we are expecting you to actually pay a much lower tax rate on it now than if you did it 20 years from now. And once it's converted to Roth, of course, it has the rest of your life to grow and then come out tax free.
Yeah, that's a good overview of that idea of the Roth conversion. To your point, for the listener at home, if you and maybe you and your spouse are working, and maybe you're in a higher tax bracket right now, so maybe you were landing in like that 32% bracket federally or the 35% bracket federally, and then maybe due to a sabbatical or due to layoffs, you
Mhm.
have time off. Right now, with that, if you have good planning, you probably have cash to cover that with an emergency fund and maybe a taxable account that you can be mindful of how much you're taking in taxes. But what that means is you're going to have virtually no income that's on your federal tax return. So you can go fill up those lower buckets, and it is a progressive tax system. So it's not like, when you were working before, you were paying 37% on every dollar in the tax top bracket. Everyone pays the 10% bracket, and then the 12% bracket, and then the
Yeah.
22%
Yeah.
bracket, and so on and so forth.
Yeah.
But so what you can do in those years when you have virtually no income is you can just go fill up that Roth, make that conversion, pay those taxes, and now you get to let that money grow tax free forever. So yeah, I
Yeah.
fully agree. That's something that we've definitely looked at with clients in those sabbatical years.
Mhm.
And it also is something that we'll look at with clients who are retired, who are in these kind of what we'll call the gap years
Yeah.
between when they made a salary and when Social Security is going to kick in, because we have virtually no income and we can really do that again and again for the same purpose.
Yeah. And that is sort of the traditional age or stage of life at which Roth conversions are discussed.
Yeah.
Which is why I love being able to focus on people in their 30s and 40s, where you get an extra, 20, 30 years of growth in that Roth IRA
Yeah.
because you get to do the conversion so much earlier.
Yeah. If
I
you're
will
if you're
say one
doubling
of
money every 10 years, right?
yeah,
If it's a 7% rate of return, then you're giving it 4x in that
yeah.
period of time. It's pretty awesome.
One of my personal biggest financial regrets is when I started this firm, we had zero income for 1 year, very little income for the next year. And I mean, I was just too overwhelmed with starting a business to have my
Mm-hmm.
mind anywhere else. But oh, what a perfect Roth conversion opportunity that would have
Mm-hmm.
been for us.
If only you'd had a financial advisor.
Right? Well, I'm looking for one now. So soon, no more giant missed opportunities.
Yes, this is exactly why advisors need their own advisor, because you were so focused on doing other things, you didn't look at that
Right?
opportunity when it was in front of you. That's why we work with lots of clients as well. Yeah, a similar along the same vein of
Hmm.
a Roth conversion is there's this idea of tax gain harvesting. Is another opportunity that clients can take if they're in a year when income's low. Right. So there, what we're doing is we're not converting from a IRA to a Roth IRA and having taxable income. We're just saying like, hey, I want to take the capital gain rate on my, I'm just going to make up that I used to work at Microsoft and have a lot of low stock basis. I want to go sell my Microsoft, lock in that gain, right? You could, if you really wanted to, you could buy Microsoft back right away. If you
Hmm.
wanted, you just have a higher basis now. Or you can go divest into other things, diversify into other things. But it's a lovely way to be really, really mindful and beneficial about um, reducing the taxes owed, but also
Over your lifetime, right? These
yep.
these two strategies or tactics we're talking about, obviously we're like actively incurring more taxes this year, which is
By
like,
doing those two strategies,
are
exactly,
you
they're
like
kind of
the
tied
dumbest
together.
financial advisors ever? But what we're really focused on is how do we minimize taxes for our clients? Or how do you minimize taxes for yourself over the course of your whole lifetime?
Exactly. Yep. Yep. Another one to think about.
Yep. All
Um,
right. So those are two, I think it's a good sort of way of bucketing them. Like there are strategies that you should think about if you know you're in an oddly low income year,
Yeah. And those
right?
are the two.
Right. And then there are strategies. Are you in an oddly high income year?
Or is it normal for you to have high income, right? And if it is, the number one thing that we'll look at with any tax year for a client is we just want to verify that you're doing the basics, the
Mhm.
foundational work, which is, are you maxing out your 401k, right? If you're in those higher tax brackets, is your 401k withholding going to pre-tax income? So you're reducing your tax bill. Because if you fund a Roth 401k and you're in a 37% tax bracket, you've already paid the taxes and now you have a
Mhm.
Roth IRA. May not be beneficial from that tax arbitrage idea of I want to defer taxes in years I'm in high tax brackets. And in the future, when I'm in a lower tax bracket, I'll happily pay the taxes. Right. So we
Yeah.
want to look at that. And then also health savings accounts as well. Did you put the money in there to help reduce your taxable income once again?
Yeah. And I think even getting away from the is it a high tax rate year? Is it a low tax rate year? It's sort of remarkably hard, I think, in a lot of the 401k systems to ensure that you actually max the 401k out by year's end, especially if you want to do it sort of evenly over the year. I certainly have some clients who are like, look, I just maxed my 401k out in with the February bonus, then boom, I'm done. But a lot of people want sort of a more steady paycheck with the same 401k contributions coming out. And it's really hard to calculate that, especially if you get a raise mid-year or something, to actually arrive at the full 401k contribution by the end of
Mm-hmm.
December. So just to elaborate on what you're saying, look at your pay stub. Look at how much you've already contributed to your 401k, how much you're contributing each pay period, and kind of do the arithmetic to figure out, am I going to get to that, well, in this case, $23,000 limit
Mm-hmm.
by the end of
Yep.
the year? Because we and the CPA firm we work most closely with, maybe a quarter of the time figure out, oh, the client's actually not on track to max out by the end of the year. And that's usually just a lost opportunity, which come January 1st is lost forever.
Right. Yeah. You said two things that I think are worth noting there. One, people who, if you are the type of person who wants to go put all of your money in when the bonus hits, that's lovely. And check to see if there's a true up provision in your 401k. So, what a true up provision is, if it doesn't have one, they can just give you the pro rata contribution for the amount of time you've been putting the money in, not necessarily just the fact that you fully maxed it out and now you're done. So you want to make sure the true up provision's there, and I'm sure that's something that Meg checks too. And then the next thing was about, what was it
And
about?
just to be clear, you're talking about getting the full employer
Getting the full
match.
match to get the match on your plans, because you guys want to, that's like free money for you guys and you want to make sure you're getting it.
Yeah.
So it stinks. You're like so happy with yourself that you put away the 23 grand early, and then you'd end up not getting the extra 4 or 5 grand right from the employer.
Yeah.
So just check with that. And what I actually lost track of what my second point was, because you were making such good points.
Oh, yes. Well, did I overwhelm you with my genius?
You did. It came back. Pro tip for you guys. The simplest way to do this is never put in a dollar amount in your pay system for how much you want to withhold. Do a percentage. Because if you do a percentage of your base pay and then you get a raise, all that's going to happen is you're still going to, so if I put in that I'm going to save, I figure out here's my salary and then I want to put in my 23 grand. So 23 grand divided by my salary is this percentage, right? And I just go save that percent. When I get a raise, it's just going to make me save the percent relative to my new salary. Now,
So more dollars.
the chances of me getting maybe missing one pay period, if there's not a true up, what we just talked about, yeah, that could happen. But chances are I'm still getting most of it, right? And it makes it so in the future you don't have to go check back in on yourself again. Be like, oh, I got a raise, or and the other thing that happens is the 23,000. That's the limit we're talking about this year. In November, the IRS will come out with new limits. It might go to 23.5 or something like that. But if you do it percentage based, chances are you get closer to those than if you do dollar based.
All right. Back to my discussion of the category of, hey, it's a really high income year. Either you just always make a bunch of money, you're making $600,000 a year, or between you and your spouse, you're making $1 million a year. You're well over the income that gets taxed the highest marginal tax bracket in
Mm-hmm.
both your state and at the federal level.
Mm-hmm.
Or normally you're not at that 37% tax bracket, which is the highest federal, but you do something like you go through an IPO and,
Mm-hmm.
$500,000 of RSUs vest and are taxed as ordinary income on one day that year. So it's sort of this anomalously high income year for you. So
Mm-hmm.
it's especially in those situations where this high income is a fleeting phenomenon, like it's a particularly good opportunity to take advantage of that high tax rate. When you get a high tax rate, you want to focus on things that are going to reduce your taxable income. You
Mm-hmm.
just talked about making sure you're contributing pre-tax to your 401k, contributing to your HSA was always pre-tax for everyone.
Mm-hmm.
Um, but also charitable donations.
Mm-hmm. Yep.
High tax rate years are great years if you are already charitably inclined. From a tax perspective, high income years are the better years to give.
Yeah, it's such a good point. It's something that we talk about often with clients in that year. So to your point, maybe you're normally in like the 24% bracket, right? And then you're going to have some big year happen where you're going to be in the 37% bracket. So you're going to be paying the extra 13% that year, and it's on a lot of money.
Mhm.
What an amazing year to go. Well, Meg, if you're my client, it's like, well, Meg, Meg, looking at your tax return, I see you normally give $5,000 a year to charity. How about this year we stack 10 or 15 years of giving into a donor advised fund for
Yeah,
you, and make it so it'll really bring down your income this year. We're going to front load all of that giving, reduce your tax bill, and now you're going to have that to give for the next 10 or 15 years, because we're
yeah,
just front loading that giving for you this year.
right. It's just some basically tax rate arbitrage.
Mm-hmm.
Yeah. Yeah, I think we have a previous episode about donor advised funds in which we talk about this idea of
Mm-hmm.
bunching multiple years donation into
Yep.
1 year, um,
Absolutely, especially
purely
with with the tax rates as they are right now. The standard deduction, I think, is 29,000 and change this year.
for a couple.
So
Yeah.
for a couple, so a lot of people where they thought they would be, I'm doing charitable giving and I have my taxes that I pay and I have my mortgage interest. But when you add all of those things up, you're actually underneath the standard deduction. So you're not actually getting the bang for your buck. So to Meg's point, she's essentially saying, well, don't just give $5,000 each year, stack it all up like we're saying, do it in 1 year so you get that tax benefit on your tax return, but then you can
Right.
give over the next few years.
Yeah, I mean, it's kind of just it's a matching game, right? In low tax rate years, there are certain strategies you should match with that, and in high income years, there are certain strategies you should match with that. And then there's just good tax hygiene in general, which is looking at your paycheck, making sure you're on track to max out your 401k, your HSA, if you have a 403b, all the retirement accounts.
Absolutely. And speaking of looking at your pay stub, the most common thing that we see with clients who get bonuses and RSU income is that they are not withholding enough taxes from their paychecks, and they will be owing come tax time.
Yeah, possibly a lot.
So again, like if you're in that 37% bracket, right? The federal government mandates that the employer withhold 22% from RSU income and bonus income,
Mhm.
right? So there's 15% just hanging out there. Well, if you have an extra $500,000 year of RSUs and bonuses, that's $75,000 of taxes that you're surprised by
Right,
when April shows up, because you
right.
think I've been withholding the whole time.
Yep. So, 2 problems there. One is you're gonna most likely get penalized by the IRS for under withholding throughout the
Mm-hmm.
year. Probably the bigger problem is, most people don't just have an extra $75,000 lying around that they have no purpose for.
That's where the projection is so valuable to me. Probably the top thing, the things that we've mentioned to this point, the maxing out 401ks, and do we do a Roth conversion in a low income year? These are really cool strategies. The Roth conversion and the tax gain harvesting, those are cool strategies in low income years. And then just making sure we're kind of doing the good hygiene things also. But the withholding is the one that really gets people. Because to your point, it's like we're not expecting it, and they have a great year and they're feeling good about themselves, And then all of a sudden there's this giant slap in the face
Yeah.
of no, you owe way more in taxes. So doing the projection ahead of time, the nice thing about it is, well, it's still a little painful. You have a lot more time to figure out how to manage that than finding out on December 12th that you owe 75 grand. I mean, sorry, on April 12th that
April
you owe
12th. Yeah.
75 grand and you have 3 days to figure it out.
That is very helpful. And, CPAs, especially, we're big, huge fans of CPAs, can help you manage that sort of withholding, or if not enough is being automatically withheld by your employer, then making sort of manual estimated payments throughout the year so that when you run the tax projection at the end of the year, there's going to be less of a slap in the face because you've
Yeah.
actually been staying on top of your true tax liability.
We see this again and again with clients, especially, the folks in the tech and biotech world, where they come to us, we look at their tax return from a previous year. It was like, I owed a giant amount of money, right? They
Mhm.
start working with us and with an accountant. And because we do some projection that year, they'll still owe a lot of money, but they will understand that they're going to owe it and it's not scary anymore.
Yeah.
And then each year it gets progressively smaller and smaller and smaller because
Yeah.
we just make better strides toward helping them understand how to get the funds set aside and optimize everything.
Yeah, it's kinda like first comes understanding, second comes action.
Yes. Mm-hmm.
Yeah.
Absolutely.
I think the one remaining reason we love and, encourage tax projections is for people who have exercisable ISOs,
Yes.
incentive stock options.
Yes. And just as a reminder, incentive stock options are slightly different than non-qualified stock options. Incentive stock options allow us to exercise. And when we exercise, we don't have to we basically get a little special treatment that's going on for that coming year. But one of the things that happens is while we don't we exercise, but we're not going to sell because we want to get a special tax treatment, right? Is
Yeah,
the this?
especially if you're in a private company.
Mm-hmm.
Oftentimes you can't sell even if you wanted to.
Yeah, you couldn't even if you wanted to, but the government doesn't really care. They're like, well, we're just going to consider that phantom income and run it through this thing called alternative minimum tax and see if you owe us taxes. And so one of the lovely things about doing a projection with an accountant is they can help you recognize the amount of shares, and the amount of shares is really in a dollar amount. So
Yeah.
you have to translate that back by price to get to the number of shares you can
Yeah.
exercise.
Options to exercise, just to be
Sorry, to be
pedantic
clear,
about it. Yeah.
options. Thank you. Thank you.
Yeah.
The number of options you can exercise that won't trigger AMT, won't trigger you owing extra tax. And it's kind of like a freebie because
Yeah.
if you're especially in a privately held company, you want to be doing that every year to start running the clock on potentially getting this gain in the future. But you don't want to pay a bunch of extra taxes.
Right. So especially if you come into a company really early stage, let's say you get some options that are priced at like 10 cents, right? So the exercise price itself doesn't constitute that much money, even across thousands of options. Now, if you have a non-qualified stock option, strike price 10 cents, and the fair market value of it, the 409A is $10, you have to pay tax on that
$9.90.
$9.90 spread.
Yeah.
But with ISOs, as long as sort of your cumulative income from all those options you exercise is under that AMT threshold, which your CPA can tell you,
Mm-hmm.
then all you have to do is pay that 10-cent exercise price.
Yeah.
I would say that both Carta and I'm missing it. If your options plan is administered by Carta, they do have a modeling tool. It's not as robust by any means as what your CPA can provide you, but it can provide you kind of high-level estimates of here's how many ISOs you can exercise without triggering
Yeah.
AMT. So there is a way to get there ballpark, even
Cool.
without a CPA.
A little aside note too, some of the things we've talked about today, they may be more beneficial this year and next year than in future years because the Trump tax cuts are set to sunset in 2025. So in 2026, we are supposed to return to higher tax brackets and a few other things. So things like Roth conversions would be more beneficial this year. Things like ISOs could be more beneficial.
Exercising ISOs. Yep.
So just keep that in mind. Who knows what'll actually happen, whether they make those permanent or not, but just food for thought.
All right. So that was a whole bunch of tax nerdery,
Mhm.
possibly a little overwhelming.
Super nerdy.
If we wanted people to walk away with just like one thing that they should do,
Yeah, if there's one
that would,
thing we could get them to do, what would it be?
yes,
Uh,
exactly.
Look at your own pay stub and make sure that you're saving enough for your 401k and your HSA if you have one, and see how much RSU and bonus income you've had this year. If you've never thought about changing the percentage on that, know that it's going to be 22%. So you might be under withholding,
Mhm.
right? You can quickly just Google search like federal tax bracket, married filing jointly or
Single,
single, and then go look at like roughly where your income is going to land and figure out what bracket you're in, and you'll know whether or not you're
under
you're
withholding.
under withholding. And if you are, make a plan for yourself. Make sure some funds are set aside, so
Yeah,
you're not taken aback.
yeah, and look, I would recommend you looking at your pay stub, at least once a year, maybe every quarter or something. It is a treasure trove of information. Sometimes you can discover things that are, mistakes that have been made. I remember one client, set her 401k to contribute pre-tax, and the change never filtered through the system. So we saw, why are these Roth 401k contributions being made?
Mm-hmm.
So, it just can tell you so much about how your money's being treated. So yeah, I recommend that in general.
And then what about in the best of all worlds? I think we'll both
Yes,
agree that
absolutely.
hire someone to
Or
help you.
hire a CPA or an EA, enrolled agent, which is a designation that not many people have heard about, but you know, they are trained. That designation is for doing taxes for people also.
Absolutely.
Um,
They're it's they're kind of unsung heroes because their job is to basically tell you that you owe money to the government. But the really, really good ones are really good at helping make sure you don't pay more than you should.
yep. And helping you figure out what are these strategies that you can do this year to make your tax situation over the rest of your life even better.
Yeah.
And we were talking earlier, we should probably just give some sort of warning to to our listeners that the the tax professional industry is kind of between a rock and a hard place right
Mm-hmm.
now. Lots of tax professionals are retiring, not many new ones are joining. So it is going to be probably difficult and definitely expensive to
Mm-hmm.
find a CPA who is both competent and sort of your needs, like equity compensation. You want a CPA who specializes in that, or like that's a competency they have.
Yeah.
They're going to charge you, like if you're paying $2,000 a year just for a relatively simple quote unquote tax return, I would not be surprised.
Same.
And it's worth it
It
in
is because
general.
if you don't know what you're doing, like I've shown an example. I haven't seen this personally, but I saw a friend saw it recently,
Mm,
where they were self-reporting their own taxes. This person
mm.
coming in, and they'd been getting their RSU, their 1099. They didn't get their 1099 supplemental, and the 1099 supplemental has the cost basis for their
Yeah.
RSUs. So RSUs, remember, they're showing up on your pay stub, but if you don't show the cost basis on the 1099 for the Schedule D of the tax return, which is where cost basis is shown for selling things, you could double tax yourself, and that's what this person did.
Yep, paying
Right?
taxes twice on the same
And they're
income.
like,
Yep.
I don't want to pay for a tax preparer, but it's like, well, you really overpaid that time.
Yeah.
So just it's totally worth it to have someone who knows what they're doing handle this. It's way too complicated to do it on our own, in my opinion.
Yeah.
And you have stock.
Yeah. Cool. Well, I hope we were very persuasive.
So persuasive. All right. Well, we'll see you guys next time. Bye.
Okay. Bye.